Hello everyone, welcome to Engineering and Economy. I'm Dr. Nathan. Today we are going to discuss about discounted payback period. So we are looking at different videos about investment decision making in renewable energy power generation. In this lessons, in the eighth lesson, we are going to look at discounted payback period. So last video we discussed about payback period. What is meant by payback period? So in solar PV system investments, we always talk about payback period. This means how many years it takes for my investment to get back whatever I invest to my hand. It means like how many years it take me to recover my investment. So that's a simple meaning of payback period. Please watch the last video. So now we are going to look at discounted payback period. As I said earlier, the countries where the economic crisis or financially not stable, like Sri Lanka, Bangladesh, Pakistan, these countries we have a heavy depreciation of currency. So currency, the money value is depreciating very fast. In that cases, the time value of money is very important. So the last video we said the simple payback period do not consider the time value of money. So we have to go for a discounted payback period, especially when we do project in these developing countries. So in that case, here is the equation. Discounted payback period is the initial investment divided by discount rate into annual cash flow. So again, this kind of equation business people, the accounting, whoever studying accounting, finance, they're using this equation. You don't need to worry about too much about equation. We are doing this in a conceptual manner. So we say the concept and we break the question into uh, information and find this solution whether to invest or not. Okay, so here is a business case. There are a lot of things about talking about the business. At the end, we said that this particular business, the owners thinking that I'll take the pen. Owner thinking that they want to get the payback period should be less than 5 years, 4 years. Sorry, it should be 4 years. So then only they will invest on this particular project. So let's look at the data here. So what they saying that these the proposed project, they have the proposed project that having 5 millions of investment, initial investment. The currency depreciation is 10%. We can take Sri Lanka as one example. Almost we are currency depreciating at 10% right now. And net cash flow first 1 to 3 years is 900,000. Then from 4 to 10 years is $2.6 million. And usual life, this is a mining project. Okay, this is a mining project. Lifespan is 10 years and salvage value is $1. Salvage mean after the end of 10 years, if you can sell the business to someone else or they sell the equipments. So here is $1 mean almost zero. We can't sell this after 10 years. So after 10 years it is everything is expired. We are not going to make any money after 10 years. Okay, this is a project. So particular investing firm saying that if the payback period, if the discounted payback period is discounted payback period is less than 4 years, less than or equal to 4 years, then they say we will take the project. So their policy is if it is less than 4 years, because major, I said earlier in last videos, the big firms and major investing firms, they have a policy. We don't invest the project where the payback period is more than 4 years because it's risky. So in 4 years time many things can happen, so we don't want to make risk. So the company policy is saying that they can invest only if the payback period is 4 years or less. So we're going to find from this data what is the payback period for this investment. If it is less than 4 years, we will invest. If it is more than 4 years, we will not invest. So we will not take the project. So how we find the payback period? So this discounted payback period, we are going to use the earlier concept, like we study the present value equal to future value divided by 1 plus r to the power n. This is the equation we have been, this is the only one equation we have been studying for last 8 videos. So in this equation, what we are doing, this we are discounting and make it in the present value. So these are the present value, all the revenue. First year we are going to get 900,000, second year 900,000, third year 900,000, fourth year 2.6 million, fifth year 2. So these are the in revenue, cash flow, the simple cash flows. So these cash flows we are going to make it in the present value. The initial, in the 0th timeline, we are investing 5 million, that is minus, negative, because it's going out of my pocket, is negative. So now we are going to invest this and we are going to make the present value. If it is used in this equation, present value PV1 for the first case, PV1 equal to future value is 900,000, you pay 1 plus discount percentage is 0.1, 10 percentage to the power 1. So this will be 900,000 divided by 1.1. So this we can write, instead of 900,000 divided by 1.1, we can write 900,000 multiplied by 1 over 1.1. This is a factoring, 1 over 1 by 1. This is a very simple factoring technique. This is used here, 1 over 1.1 equal to, this is equal to 1 over 1.1. This factor is 1 over 1.1. So this 1 over 1.5, 1 we are using as a factor. So the second case, what happened for the PV2? If you do the PV2, you can understand what this table method. We can do manually, like 1 by 1. We get the answer here, and also we can do manually. But this table is easy, so I'll explain the table. Okay, PV2. What is PV2? PV2 is again second year revenue. In the second year, revenue is 900,000 divided by 1 plus discount rate 0.1 to the power 2, because second year. So to make it present value, what we are doing, 1 over 1.1 to the power 2 multiplied by 900,000. 1 over 1.1 to the power 2 will be 0.8264. So this is a present value factor. We call present value factor. What is a present value factor? So this factor is a present value factor. Next it will be 1 over, this become 1 over 1.1 to the power 3. Next will be 1 over 1.1 to the power 4. So these are the factor, 1.1 to the power 5. So these are the factor multiplying by the particular cash flow, then become a present value of the cash flow. So then what we are doing, we are adding with the investment. Investment is negative. So adding with the investment and checking whether I'm getting 0. If it's 0 means we are getting the payback period. So first year we are adding, this is my present value of the investment, the revenue, present value of the revenue, sorry. So we are adding this one together with the investment. Investment is negative. We are getting a negative 4.5 million. Again, next time we are adding negative 4.5 million plus this revenue, present value of revenue. We are getting again negative 3.4 million. Again, next revenue, adding with this revenue with the value, we are getting negative. So we are not getting in the 0th year. Definitely we are not getting payback period. Not first year. At the end of first year, we still in the negative. End of second year, we still in the negative. End of third year, we still in negative. And end of fourth year, we still in the negative. And end of fourth year here, sorry, here we are adding again, we still in negative. We are in the negative. So this is also negative. So it means at the end of fourth year we are not getting the money back. Checking the end of fifth year. End of fifth year, it's become positive. So at the end of fifth year, we already crossed the payback period because it's become positive. So the payback period comes between 4 years to 50 years. Maybe it's 4.5 year or 4.6 year, somewhere between 4 year to 5 year. But from this example, we understand that it's more than 4 years, so we are going to reject the project because the policy says that we cannot accept the project if the payback period is more than 4 years. Okay, that's clear. Now we find what is exactly the payback period. So 4 year and remaining this much of this has become positive. If you look at the previous table, this value is positive. This value divided by the total, the discounted payback period for that particular year, it will become 4.5. Like we have to find in the ratio how much money each month, like each month from after 4 years we are going to count the month, how many months. To count the months we are doing this calculation. You can, it's very simple, you can refer back the table, you can understand. So this is 4 point, so my payback period is 4.5 years. Okay, discounted payback period is 4.5 years. So we don't accept the project because discounted payback period is more than 4 years, so we don't accept the project. So this is a decision. Thank you very much for watching this video. Please subscribe this channel.